Right. Okay. So I think we'll make a start as others are joining us. Very welcome to this fourth in our series of Exposure Draft 3 explainer videos for international nonprofit accounting guidance. My name is Samantha Musoke. I'm the project director with Humentum based in Uganda, and I'm delighted to be joined by Karen Sanderson, our resident expert on all things technical director of INPAG with SIPFA, dialing in from Northern Ireland, no less. So welcome, Karen.
Thank you.
Super. Now, this webinar is in English, but we would love you, if you're speaking French or Spanish or other languages, we want you to be able to participate. So, Brian, if you'd be kind enough to post in the chat these instructions, which are in French and Spanish in the Word document. So go to the More button at the top and the 3 dots at the top of your screen. Click Language and Speech and turn on live captions so that you can see the captioning. Then when you have the captions displayed at the bottom of your screen, there's a little settings cog in the top right-hand window of that, top right corner of that lower window. And here you have the option to change the caption language into one of 28 languages. Please do not change the spoken language because we are speaking English. So don't change that. If you change it, it will come up with a warning sign saying change for everybody. Please don't do that. Change the caption language. We can also translate the chat, which means even if people are typing in other languages, you can read them in your own language. So go to the chat, hover over a message, and you'll see the 3 dots. I'd recommend this also for English speakers, so that if other people are typing, you can also see it in English. After the 3 dots, there's the translation option. You can click Settings, and then it takes you to the Appearance and Accessibility menu. When you scroll down, you get to the language settings, and you can translate messages into whichever language you pick. And then how to handle other messages, you can auto-translate all messages. Okay, so with that, and as I said, the instructions are in the chat if that's helpful. Let's get going into the actual topic of our webinar. So this is the fourth in our series. The recordings for the previous ones are available on the website, and as this one will be in a couple of days. Our next one on illustrative financial statements has been moved to the 14th of August. So you've still got time to register for that one. We look forward to seeing you there. The purpose of these videos and webinars is to enable you to understand the proposals in Exposure Draft 3 precisely so that you can share your feedback. This is part of a public consultation process. So the flow for our session today is the introduction, which we've basically had. We're then going to watch a pre-recorded video. And during the video, please do put any questions or comments into the Q&A function in Teams. I hope Brian will also add something in the chat about how to use translation options in Teams if you're joining from a laptop or from a mobile, or if you've got a Teams account or not. Those instructions will also be there in the chat. So you can use the Q&A function. If you can't access the Q&A, then by all means use the chat, but it's helpful because we can vote up questions. We will show the video in English, but it will also be available in YouTube in other languages. I'll come to that in a minute. Then we'll come back together for questions and comments. And finally, I'll explain exactly how you can respond and share your opinions. So in YouTube, there will be the other videos in French and Spanish if you'd like to watch in that language at the same time as we watch it in here in English. So I can't speak English today. I don't know what's happened. So the links will be there. You watch in YouTube and then come back to this Teams meeting so we can have our Q&A together. Now, if you're doing that, you'll want to silence the audio from this Teams meeting, even as you're watching the other video in YouTube on a different browser or a different tab. To do that, again, you go to the 3 buttons for more. You go to audio settings and you click the speaker to turn this meeting onto silent so that you can watch the video in another language. Okay, with that, if you've got any problems, do type in the chat and Brian is ready to help you. With that, we're going to watch this video in English. Tell me immediately if you can't hear it. I'm going to turn all my volumes up and hopefully this will work.
This video explains the key proposals in sections of International Nonprofit Accounting Guidance, Exposure Draft 3, that are not covered by the other videos in the series. The other videos cover fund accounting, expenses, and supplementary information, including donor reporting. INPAG uses the IFRS for SMEs accounting standard as its foundational framework. Prioritized topics have been reviewed in detail. The remaining sections have to be considered for consequential amendments to align with the reviewed sections. To be clear, these remaining sections have not been reviewed in detail. Exposure Draft 3, or ED3 for short, introduces a number of sections. These are fair value measurement, investments in associates, joint arrangements, investment property, property, plant and equipment, intangible assets other than goodwill, business combinations and goodwill, leases, liabilities and equity claims, impairment of assets, related party disclosures, and specialized activities. ED3 also includes important guidance about the transition to INPAG. We are also sharing updates to previously published sections where there have been amendments to take account of feedback on ED1 and decisions made during the development of ED3. ED3 also includes additional draft guidance recently published by the International Accounting Standards Board. To ensure consistency, we've implemented common editorial changes across all sections. Firstly, INPAG includes terminology changes to use terms that are more specific to nonprofit organizations, or NPOs. For example, the word entity is replaced with NPO, and the term profit or loss is replaced with surplus or deficit. Secondly, the names of some primary financial statements have been changed. INPAG proposes to have a statement of income and expenses and a statement of changes in net assets. The statement of comprehensive income has been omitted. All references to financial statements have been amended accordingly. Thirdly, there are some consequential changes as a result of amendments to other sections. These editorial changes ensure alignment across INPAG and consistency with the proposals in Exposure Draft 1 and Exposure Draft 2. The topics in ED3 have been broken into groups for the purpose of this video. Firstly, are the topics related to fair value measurement and impairment. Secondly, topics related to equity. And thirdly, topics related to other entities in which an NPO has an interest. The remaining topics are then covered before the final section on guidance for NPOs transitioning to INPAG. The first group of sections relate to the use of fair value measurement and impairment. Included in this group is Section 12 on fair value measurement, Section 16 on investment property, Section 17 on property, plant and equipment, Section 18 on intangible assets other than goodwill, and Section 27 on the impairment of assets. Section 12 provides guidance on how to measure assets and liabilities using fair value. In essence, fair value is the estimated price at which a good, service, or asset is bought or sold when the buyer and seller freely agree on a price. It is a rational and unbiased estimate that takes account of factors like the replacement cost and supply and demand. These steps create what is referred to as an orderly transaction. Fair value can also be used to estimate the amount needed to settle a liability. Exposure Draft 2 included proposals for revenue accounting that makes use of fair value measurement. Where assets are donated, they are measured at fair value on initial recognition to determine a deemed cost for the asset. This approach to measurement covers donated inventories, investment property, property, plant and equipment, and intangible assets. While this section was not subject to detailed review, to support the INPAG proposals, ED3 contains new application guidance and 2 new illustrative examples. INPAG includes a hierarchy for fair value measurement. The highest priority is given to level 1 inputs, where there are quoted prices in active markets for identical assets and liabilities. If an NPO holds listed stocks or shares for investment purposes, this would be level 1 on the hierarchy. Level 2 inputs come from quoted prices for similar assets. For example, if NPOs have investment properties, these could be valued by looking at the prices of similar properties in the area. Lowest priority is given to level 3 inputs, where the inputs to the valuation are not observable. They are not observable because they don't come from quoted prices or other publicly available information. Many assets held by NPOs are expected to be measured using level 3 category of information because they have been donated or are held for delivering the NPO's objectives rather than for commercial purposes. The information used for measuring these assets will require elements of estimation and judgments. This hierarchy of inputs also applies to liabilities. For level 3, there are 3 widely used valuation techniques. These are the market approach, the cost approach, and the income approach. The cost approach is the technique most likely to be used for measuring donations in kind at fair value. Importantly, this technique takes account of the value of the asset to the NPO in terms of its capacity to serve the NPO's missional purposes. This concept is called service potential. When measuring an asset's service potential, its current location and technical specification are not considered. For example, a donor may provide office space, which the NPO cannot sublet. The office space has a specification that is greater than the NPO needs for its operations. As this office space cannot be sold or used by anyone else, it is the service capacity that is relevant, not the commercial value of the office space. The fair value will therefore be determined with reference to office space that would meet the operational needs of the NPO. Fair value measurement also applies to donated services in kind. For example, a doctor based in country A may give their time to train doctors in country B. The fair value of this donated time is calculated with reference to the cost of employing a doctor with equivalent experience in country B. The actual salary of the doctor in country A is not a factor in determining the fair value. An NPO may use the replacement cost, which provides the value of an equivalent item in local use, termed its value in use. Alternatively, an NPO may use the cost to the donor as the deemed fair value, where this is known and is relevant. Where an NPO is operating in a crisis situation, it may be impracticable to determine a fair value, particularly for inventory it is receiving. Due to these pragmatic constraints, such items are not required to be recognized in the financial statements, but disclosures must be made instead. Whether donated or not, many assets held by NPOs may be difficult to value. This may be because they are unusual in nature, heritage assets such as historical sites, or simply because they do not generate cash flows. INPAG clarifies that the cost approach is to be used for these assets. This results in a value based on the current cost to replace the service capacity of an asset. INPAG provides additional guidance where there is a restriction on how it can be used. The fair value is based on its highest and best use, with those restrictions in place. For example, if an NPO has been donated land that can only be used for a children's park, no account can be taken of the possibility of the land being used for housing development. This possibility can be reflected in the fair value only when the restriction has been removed, and the NPO can freely sell it. Section 16 sets out the accounting treatment of investments in land or buildings. Where these are held to generate rental income, or for their capital appreciation. This does not include property held to deliver an NPO's mission or objectives. So this section does not apply to property such as social housing. Purchased investment property is measured at fair value, where it can be measured reliably without undue cost or effort. Otherwise, it is measured using the cost model in Section 17 Property, Plant and Equipment. Where an NPO receives a donation of investment property, it is measured at fair value to establish its deemed cost. Some property assets could be multi-purpose, partly an investment property and partly property for use by the NPO. The property needs to be separated and valued based on the primary purpose for which each part is held. Section 17 specifies the accounting for property, plant and equipment, which are also known as tangible fixed assets. It covers capitalization and depreciation. It applies to all tangible that are held for use in the activities of the NPO and are expected to be used during more than one reporting period. As previously discussed, this section also applies to investment property that is used for service delivery or whose fair value cannot be reliably measured without undue cost or effort. Section 17 permits assets to be measured using either a cost model or a revaluation model. Each model has advantages and disadvantages. The cost model is simple to apply, while the revaluation model allows a measurement that takes into account the value of the asset to the NPO. NPOs can decide which is most appropriate. When NPOs receive donations of property, plant and equipment, these are measured using fair value on initial recognition to establish a deemed cost. In INPAG, assets are recognized when they meet the definition of an asset. In some jurisdictions, it is common practice to expense grant-funded assets. To be clear, INPAG contains no exceptions for assets that are donations. All grant-funded assets must be capitalized if they meet the definition of an asset in Section 17. This also applies to investment property and intangible assets. Depreciation or amortization is included as an expense in the same fund where the asset sits. For purposes of reporting to donors, there is a INPAG Practice Guide 1, Supplementary Statements. It includes the option to remove depreciation or amortization and show capital expenditure on the acquired or purchased asset, which is a preference for many donors. Further information can be found in other videos in this ED3 series. Section 18 sets out the accounting for all intangible assets other than goodwill. An intangible asset is an identifiable non-monetary asset that does not have a physical licenses or software. NPOs can receive donated intangible assets, for example, rights to royalties from a book. INPAG requires that donated intangible assets are measured at fair value on initial recognition. This establishes a deemed cost for the donated asset. Section 27 provides guidance on the impairment of assets. An impairment occurs where the carrying amount of the asset is higher than its recoverable amount. In these situations, the carrying amount is reduced to the In INPAG, the recoverable amount takes account of other economic benefits and service potential, as well as any cash asset. In Exposure Draft 2, there was a proposal for a new measurement base for inventories that are held for distribution at no or nominal cost. It proposed that this inventory is measured at its cost, adjusted. This new measurement base has been added to the requirements of this section. When making assessments for impairment, the IFRS for SMEs accounting standard refers to cash-generating units. This allows the assessment in situations where it is not practical for an individual asset to be assessed for impairment. In INPAG, the term cash-generating changed to operating unit. This specifically allows the inclusion of assets that do not generate cash, because they are held for missional purposes rather than cash generation. An operating unit is defined as the smallest identifiable group of assets that includes the asset being impaired, and that is operated independently from other assets or groups of assets. Moving on, in this next block of topics, we examine the revised proposals in Section 2 concepts and pervasive principles relating to net assets and equity. We will consequential impacts on Section 22, which is now called liabilities and equity claims. In a for-profit context, equity refers to the owner's entitlement to the net assets of the business. A survey we conducted in 2023 found that in the rare cases where NPO equity instruments exist, they do not generate any entitlements other than a return of funds put in. We had originally included equity as a financial statement element in Exposure Draft 1. But in response to feedback and the survey, it is now proposed to be removed. As the net assets of an NPO are held in a fiduciary capacity for service beneficiaries, it is proposed that the term net assets replaces equity as a financial statement element. Net assets is defined as the residual available to the NPO to achieve objectives after deducting all its liabilities from its assets. This makes clear that the net assets are for those that benefit from the purposes of the NPO rather than those with ownership interests, as is the case in the private sector. In the rare instances where NPOs have some form of share capital or similar instrument, INPAG refers to these as equity claims. These are a subset of net assets. Equity claims are the financial interest in the net assets of an NPO that is due to equity claim holders. This reflects that the net assets are there for the NPO to achieve its objective and not primarily for distribution. Equity claims can provide an entitlement to distributions, assets over liabilities in the event of the NPO being dissolved. In some cases, this financial interest may be sold, exchanged. Use of the term equity claims is intended to create separation from how equity is used in the private sector. Significant amounts of equity claims are not likely to be being an NPO. Section 22 establishes the principles for classifying financial instruments as either liabilities or equity claims. As is not used in INPAG, and Section 22 has been amended to reflect the use of equity claims instead. It also includes important clarifications. Where an NPO issues membership shares that provide no entitlement to the NPO's net assets, they are not equity claims and instead are to be treated as liabilities. Funds received by an NPO provide the donor with governance rights, but do not establish a financial interest in the net assets of the NPO are not equity claims. Guidance has been Section 22, where it related to the use of equity claims for their trading value, as well as share-based payments. This next block of topics relates to Section 14 Investment in Associates, Section 15 Joint Arrangements, and Section 19 Business Combinations, including goodwill. Sections 14 and 15 provide guidance on accounting for associates and joint arrangements, respectively. An associate is an entity over which an NPO has significant influence, controlled by the NPO, or is not a joint arrangement. A joint arrangement is where the NPO and other parties to the arrangement share control of that entity. No major editorial changes are proposed for either of these sections, other than to reflect the relationships that an NPO may have with these types of entity. Section 9 on consolidated and separate financial statements, which was in Exposure Draft 1, will be useful in making assessments about interests in other entities. Of INPAG applies to NPOs that entities, including where they merge operations with another NPO. The purpose of this section is to provide guidance about how to recognize and measure the assets and liabilities acquired in the combination. While the idea of running a business may not resonate in a nonprofit context, the term as defined in INPAG establishes principles relevant for NPOs. A business is defined in terms of an integrated set of activities that must have an input, and processes applied to those inputs to be able to create an output. The characteristics of a business now include the types of activities carried out by NPOs, for example, providing services to service beneficiaries. The section also covers NPO combinations that are motivated by an NPO's missional objectives, not just financial considerations. To apply a simplification the situations where two NPOs that both have positive net assets combine. Additional procedures have been removed, as the cost of applying these are considered to be disproportionate to the benefit. There are 5 other topics, including 3. Sections 7 and 30 were included in previous exposure drafts and are updated to reflect additional proposals made by the International Accounting Standards Board. There are no proposed changes to Section 20 on leases and Section 34 specialized activities, other than for editorial purposes. The 5th section is Section 33 on related parties. This was partly covered in the ED3 video on expenses. Section 34 on specialized activities includes guidance on 3 types of specialized activity: agriculture, extractive activities, and service concessions. No adaptations have been made to this section, but feedback is requested on whether any of these activities are relevant to NPOs. Additional text was published by the International Accounting Standards Board on 28th of March 2024 in the addendum to the draft 3rd edition of the IFRS for SMEs accounting in ED3. There are new disclosures in Section 7 on the statement of cash flows for supplier finance arrangements. These are arrangements that provide NPOs with extended payment terms, or NPO suppliers with early payment terms. There is also additional guidance for Section 30 on foreign currency translation. This covers the procedures to be followed to estimate a currency is not exchangeable. It also includes disclosures about estimates and impacts relating to foreign operations. Disclosures about related parties are required to draw attention to the NPO's financial position or its surplus or deficit have been affected by transactions between the NPO and a related party. It is common that oversight and control of an NPO is exercised by a separate governing body, often voluntary, who are not employed by the NPO. These can be known as trustees, boards, or similar. NPO governing body members are considered in INPAG to be a related party, whether or not they are paid. NPOs must consider whether their governance arrangements result in other related parties. INPAG does not require the disclosure of transactions with governing body members where any grants or donations they make or services they receive are made as part of an arm's-length transaction or received on the same terms as service recipients. As no new disclosures have been added about taxation and out-of-pocket expenses for these governing body members. Grant providers are generally not related parties. However, if the funds that they provide are significant to an NPO, and they are able to exert influence over the NPO's total operations, they may be a related party. The final section of this video looks at the guidance for those NPOs adopting INPAG for the first time. Section 38, Transition to INPAG, applies to any NPO adopting INPAG for the first time. It sets out the requirements for recognized abilities to create an NPO's first statement of financial position that is compliant with INPAG, and for the narrative report. In adopting INPAG for the first time, NPOs are required to provide comparative information for the previous reporting period. This means that accumulated funds that contain historic surpluses and deficits must be split between funds with restrictions and funds without restrictions. The requirements are based on the importance of transparency over balances on funds with and without restrictions for narrative reporting, both of which have been emphasized by stakeholders. The date of transition to INPAG is the beginning of the earliest reporting period for which the NPO provides full comparative information in the financial statements. A transition period is permitted if this allows confirmation of compliance with the requirements to be made only for the financial statements, without the narrative report, for the first 2. Narrative reporting requirements must be met within 2 years of the first financial period, for which compliance with the financial statements is expressed. Compliance for the financial statements only will not be possible after this point. Section 38 also allows those NPOs that are not yet able to express compliance with INPAG to explain whether they have adopted any parts of INPAG and their plans for achieving full compliance with INPAG. All assets and liabilities that are required to be recognized must form part of the opening balance sheet. This includes the assets and liabilities that relate to enforceable grant arrangements, EGAs, to ease transition, specify transactions that do not require the retrospective application of INPAG. For example, only grant arrangements that are due to be completed more than 12 months after the date of transition to INPAG need to be included. So if an NPO has a transition date of the 1st of January 2026, and it has a grant arrangement that is due to be completed in that year, this grant arrangement does not have to be reflected in the balance sheet. Only grant arrangements that are due to complete after the 31st of December 2026 need to be reflected. This applies to all grant arrangements, as they impact assets, liabilities, and fund balances. Fair value measurement can be used to create a deemed cost for specified assets and liabilities where these were not previously recognized. This includes property, plant, and equipment, heritage assets, endowment funds, and inventory. All loans that have been provided at below market rate of interest must be recognized using the requirements of Section 11 Financial Instruments. This video describes a limited number of amendments across several sections that have been made as a consequence of changes to other sections of INPAG. These sections have not been reviewed in depth. Donated assets can be significant for NPOs. Sections 16, 17, and 18 have been updated to clarify that the initial recognition of donated assets using fair value creates a deemed cost for donated assets. As fair value is significant to donations in kind, additional application guidance has been developed, clarifying how to apply the fair value measurement requirements. The term equity has been removed as a financial statement element and replaced with net assets. Equity claims has been added as a term to describe equity instruments. Amendments have been made to the section on business combinations to clarify how its requirements apply to NPOs. Finally, we describe the requirements for any NPO transitioning to INPAG. This includes a transition period to allow the adoption of narrative reporting requirements and clarification about how the requirements apply to NPO-specific transactions. We look forward to hearing your feedback on these proposals. To respond, visit www.ifrfornpo.org/have-your-say. The invitation to comment includes questions on particular areas where we would like to have feedback, but comments are welcome on any aspects of the proposals. Download a template response document and upload your completed response or comment letter. Responses must be in English. The deadline is the 16th of September 2024. This video.
Super. Okay, well done. That's quite a marathon. I'm going to stop screen sharing now so that we can have a time of Q&A. I know this is quite long and quite detailed and quite in depth. It's kind of the odds and sods, the bits and bobs, the leftover bits after we've addressed our really hottest topics. But there's still some really consequential things in there relating to fair value and asset capitalization, transition, things like that. So we'd love to see what questions and comments you have. I put one in there to get us started, but I'd love it if I can see some others. Mark's got one. Well, let me start with mine first, Karen. I saw that on the related party transactions section, it said that the reason for doing this is because the influence that related parties exert could impact on the surplus or deficit or the asset. And I was thinking they could, in a non-profit situation, exert things like who benefits, who gets on the list of, people who benefit from the services, which wouldn't necessarily have any impact on the financials, but could still be a sort of influence. Now, is there any scope to change that if we wanted to, or because it's part of these unreviewed topics, we just have to live with it for now? I'd love to hear your thoughts on that, Karen.
Yeah, look, and you're right to point this out, and we need to be really clear that because we've focused our resources, we haven't gone through every section in depth. What we've tried to do is to pick up where we have um, identified a change in another section and look at, well, what that might mean for the sections that we haven't reviewed. And of course, when we're looking at grants and donations, they are something that isn't in other standards. It's something that is specific to what we are writing in INPAG. And so if there are issues that are related to those types of transactions, then we will look at whether there are consequential amendments needed for those. So I think in the context of the question that you just asked about, well, can you influence, who might get grants or how grant money is used, that absolutely is something that we could consider as part of this. And of course, we're looking at, we've got a whole new section at the beginning of this about NPOs, who they are, and, who the users are, who the primary users. So things that emanate from that are also kind of in scope of where we would be looking at, where we can kind of see a direct consequence.
Super, thanks. So let's see how that goes. Mark's asked a question. He says, I can see that the ED has taken account of developments in the IFRS, especially IFRS for SMEs to date. Are any more relevant developments expected in the next 18 months? We want stability. We want to adopt INPAG knowing that it's not going to change. What's on the horizon in terms of that?
Well, I think one thing that we know is that the world of accounting is forever a changing development. There are new ideas, new issues emerging all the time. And we were really keen when we were establishing INPAG and developing it, is that we do create something that is stable and not something that is constantly changing. The IFRS for SMEs revised edition that is currently being worked on at the moment is due for publication in 2025, ahead of INPAG. And what we will be seeking to do is to make sure that anything that is captured within the updated standard to be issued next year is captured within INPAG, so that the basis is consistent. And at that point, we will kind of call a halt to things. We don't anticipate reviewing the content of INPAG for those kinds of developments for probably another 5 years. So if you like, even though there might be developments in IFRS, we will look to take a pause, not bring those in straight away, and look to revise INPAG in probably 5 years' time after publication, to look at the extent to whether any of those new developments apply or are relevant to what is in INPAG. So although the wider world is still in flux and still developing, we will kind of crystallize what is in INPAG. The only exception that I can think about outside of that was if there was a very urgent issue that emerged that was kind of fundamental to the financial information. I can't think what one of those might be at the moment, but I think we would always want to provide additional guidance or clarity should those things arise. But the normal development of accounting standards will happen as it normally does, and then we will look periodically to see to what extent we want to build that into INPAG.
Brilliant, thank you. I'm not seeing other questions in the Q&A. I'm just going to check in the chat if there are any there. I'm not seeing any. If you've got questions or comments, please, we want to hear from you. I can ask questions all day, but we want to hear your questions and your thoughts. So please do pop them in there. No question is too small or too large. Don't imagine that you're the only one that's worrying about this. I promise you others are as well. So please be brave and put your question out there. So I had a question, Karen. And I know we've been talking about this since 2019, assets, grant funded assets. And it mentioned in the video how often some MPOs expense their assets. They put it in the expenditure section of their accounting records so that they can do their accountability to funders. And what it said in the video is that INPAG does require it to be capitalized and depreciated if it meets the definitions of an asset. And I'm thinking about all the ledgers I've worked in and all the different organizations I've worked in, and how do I do that? How do I expense it for the donor's sake and capitalize it to comply with INPAG? That just seems such a huge thing to be buried within a sort of other topics video. I wanted to surface it as a question, as an issue, and hear your thoughts. Thanks.
Yeah, no, look, you know, we've heard about this time and time again. But you know, what we're developing in INPAG is an accrual-based standard that reflects the kind of internationally accepted approaches to these things. And so if you have got something that meets the definition of an asset, it's going to be used for multiple reporting periods, then we would expect that to be capitalized. And then for if it has a finite life, for that then to be depreciated over its life. We also hear about, you know, that donors kind of want to see that the money has been spent on the asset for which it's been given funds, and they want to see, you know, that accounted for in the period in which it's happened. You know, and that is why we have developed INPAG Practice Guide 1 for donor reporting, which provides flexibility to provide information either about the whole of the MPO, aggregations of programs and projects, or to focus on an individual project, program, or grant. And in that, we have put a section in there that allows you to show what has been expensed in the period on an asset. Of course, we want to make sure there's no double counting in there. So we say, well, the depreciation that you charged on the asset, you need to take that out so that you haven't got the depreciation and the expense that was incurred on the asset in the same statement. But there is the ability to show that you did spend the money on a capital acquisition in the reporting period, but it's through those supplementary statements that we've created as the mechanism to do that, so that the main accounts remain true to the accrual-based principles that are on which the whole of INPAG is based.
Super. And I in the video on fund accounting, I recall there was an example where you've got a grant funded asset that's being depreciated through the fund, and then its restriction is removed and it's transferred out of funds with restrictions into funds without restrictions. It's quite a nice worked example. So that might be something, again, that people want to look at. I'm also thinking it would be really nice to test this with a couple of organisations and see the financial reporting sort of output reporting presentation part of it is clear in INPAG. I think there's a number of different ways to make that happen in the back end of an accounting system. And I think it'd be quite interesting to test that or try that out with a couple of brilliant people such as we have here and see ways to make that work and make it practicable. Brilliant.
Go
ahead.
Can I just say one other thing as well? Of course, that, you know, one of the things that we you know, want to see to support all of these things are software to do that. And of course, you know, as the proposals in INPAG, you know, become more certain, you know, then, you know, we'll be able to have much more positive conversations with software providers who can then look at actively supporting the proposals that we've laid out.
Yeah, wouldn't that be easy? So it's just a nice, easy screen. You put it in once in one way, and the software does all that jiggery pokery but for you and spits out the reports. That would be really, really nice. I can't wait for that day. Mark has got another question here about the hierarchy. So will INPAG include or refer to a hierarchy of standards? So number one, apply INPAG. If INPAG is silent on something, then go to IFRS or IPSAS. or IFRS for SMEs or something. And then if that's not there, then go to your own national GAAP if it exists. It's that type of, acknowledging that, INPAG hasn't addressed everything. As you've said, these are things that haven't been reviewed in great detail. So there might be potentially conflict with national GAAP sometimes. I don't know, but what's the thoughts on the hierarchy on what else you can apply?
So INPAG does explicitly say, and I can't remember exactly where it says it, but it was definitely in Exposure Draft 1, that, if INPAG does not cover the type of transaction that you need, then you may refer to these other standards. We don't have a hierarchy on that. I think it's a really good point. I mean, I think I would certainly be looking to international standards as the first point, but it's a question of where you can find the transactional guidance, because if it's not in IFRS for SMEs, it might not be in IFRS because it's related to a transaction where there is not that kind of exchange, that direct exchange of goods for money or things like that. So Ipsos might be more appropriate to look at. But we know that the international standards have been developed under international due process. So we would advocate looking at that first. But of course, some jurisdictions have also got their own gap for non-profits, and it's possible that they have got solutions to that as well. I think we explain that in the basis for conclusions, but that will make sure that is clear, because I think it's going to be what's the most appropriate source. And I can think of an example off the top of my head where we proposed an Exposure Draft 2 that we removed the section on share-based payments. It is possible that and very rarely that some NPOs might have transactions that fall into that realm. Or we would expect them to look at IFRS for SMEs or IFRS in full to assist if they've got those kinds of transactions.
Brilliant. That takes me beautifully, Karen, into David Hardage's comment. He's scratching his head. We'll need to look carefully at this equity instruments versus net assets thing. And he's saying, I do see NPOs with equity instruments, often nominal. So this is, I think, example, like in the video, it's like somebody's put in something to get, usually something sort of foundational input to get an NPO registered, usually nominal. Usually your only right is to get back what you put in, and nobody really expects that often either. And might also have things like merger reserves or revaluation reserves as part of net assets. And he's saying he's also seen NPOs with equity holdings in other NPOs with significant value, i.e. net asset backing. What are your thoughts on that comment? Reflections on that comment?
Look, this has been a really tricky issue, and we did expose it back in ED1. I don't think there were issues with what we were proposing that we've looked at and kind of emerged as part of our further thinking, which is why we've revised the proposals in ED3. And of course they are still proposals, so we very much welcome feedback on that. But at the crux of what we were trying to deal with is that because non-profit organisations don't operate for profit, and part of our definition is about surpluses being reinvested in the services that the NPO provides, not for private distribution, and if there is any private distribution, that is incidental. There is a difference between non-profits and them operating for the benefit of their beneficiaries versus in the private sector that operates to the benefit really of their shareholders, in terms of what they get out of the investment that they've made. And so there is a very different underpinning concept here. about what people do and why they do it. And we feel that ownership in the way in which it exists for private sector entities doesn't translate for non-profits, because the objectives are different. And in reality, what happens to the funds and resources in the NPO are different as well. And so we wanted to put new terminology to that to show that difference in kind of behaviour and reason for being that exists. But it is very tricky, because we do know that some NPOs do have equity, and equity for the reason that you described. So we can't ignore it in terms of how it sits, but we got to try and find the balance of how that is explained and presented in the guidance. So yes, it is a very tricky area, and one on which we would very much welcome feedback to make sure that we have got this right in terms of how it might apply to those NPOs that are operating using INPAG, as opposed to other entities that might be using a different framework.
Absolutely. Thank you. And David, we really look forward to your response to the ED3. I'm sure you're preparing it already. Mark says, copying a question from Jose in the chat. Thank you, Mark. Jose has said, in Latin America, and speaking specifically of Venezuela, it's not common to value assets by highest and best use. How do you think should be the best strategy in the transition process for these values? Do you take a deemed cost as to the fair value?
So I think we have to think about where we're going to be using fair value. For the majority of assets that an NPO has, you're likely to be using the historic cost if that's already in your accounts. You're not likely to use fair value. I think fair value is it's a choice that can be used, but it does have some complexity. It has some benefits, but it has some complexities attached to it. And many may choose to use the cost model, so this won't apply to those kinds of assets. Where it is going to be relevant is if you have got a donated asset and you've got to put a value to that donated asset. It's also going to be relevant if you don't have accrual-based accounts currently, and so you don't have a fixed asset register, you don't have any assets on a balance sheet, at which point you're going to need to identify all of the tangible and intangible assets that you've got, and then put a fair value to them. So I think that this is less about a transition, I think, but more about what are the approaches that you might take to those things. And I think, as we have said, that we think that given the nature of assets that non-profit organisations have, particularly with donated assets, you'll need to develop a valuation and what we use calling the sort of the cost technique, where you're looking at what would it cost to replace the service capacity of that asset. So if you like, what would you have to spend to create the same capacity as you have now? And so in terms of that highest and best use, for those kinds of things, probably slightly less relevant. But it comes into its own where you've got things like land or buildings of some description, and if you were able to freely sell it, you could command the highest price on the market. That might not be what you paid for it a long time ago. It might not be how you're using it now, but reflects actually the value of it to the NPO, because you could sell it, or potentially could sell it in that situation. So you're really, I think, but for the majority of assets, I think you're going to be looking at what is the service capacity of that asset, and what would it cost to create that same capacity. And so that highest and best use is probably going to be a little bit in the distant when you're thinking about that, because the focus is going to be on service capacity rather than what's the maximum value I could get for this.
I really like that. And I remember when we were first talking about service potential and impairment, which is Jose's other question. And I remember thinking, like, how am I supposed to put a value on children playing in a playground, for example? I can't put a value on that. That's just, it's impossible. But this is about impairment. If the asset that you've got, which is supposed to be able to provide, the facilities for kids to play, and it can't do that, and you were going to have to replace it, how much would you have to spend? And that's a bit more, I can get my fingers around that. It's not so nebulous and impossible to put a number on. So I'm quite encouraged that what I thought would be fair value horrors are actually a bit more rooted in reality, which is really nice. Now, we've got 3 minutes left, so I'm just going to take you briefly through the last slides to show how to, I hope that's showing up for you. Can everyone see that? So this is, check it is there.
It's not there yet, Sam.
There we go. Can you see that now? Share your voice. Brilliant. Okay. So the whole point of sharing these things is not just to have an intellectual conversation, it's so that you can frame and give your feedback. So to do that, you go to the website, to the Have Your Say page. Download a response template, which is a Word document, and you can fill in your own details. Form your opinions, like watching the videos, the explainer videos, reading the documents, coming to webinars like this, and participating in outreach events. There's a little box where you can write your thoughts next to each question. You don't have to reply to everything. And if you have a comment that you want to share that doesn't seem to relate to one of the questions, you can put that at the end. There's a general section at the end. And if you don't want to use the template, that's also fine. You can just write a letter, but please do help us with references to the sections, because that really helps us in the analysis and being able to action your important opinions. If ever you want to say, if you don't agree with something, it really helps to say what you'd like instead, because that just helps us with assessing what's possible and moving forward. Finally, when you've done your document, you just upload it through that same page. Have Your Say. This is a simple form. What happens with all your opinions? They get analysed in detail. We will be putting some of the ideas to focus groups. We've set up 4 standing focus groups. Then after that, they'll also go through the advisory groups, the practitioner and technical advisory groups with broad international representation for their input. We're looking to sign off Q1, Q2 next year and publish mid-2025. Dream come true. Please do stay in touch via the website, the newsletter. There's a new web page where you can demonstrate your support. You can upload your name or your logo. And this is really helpful in us being able to show the stakeholders that are engaging with us, and it helps us advocate to decision makers like donors and jurisdictions. I'll stop there. Thank you so much for your time. Thank you, Karen, for your brilliant wisdom, and thank you everybody who's thought and reflected and taken the time to engage with this material. Really grateful. Have a super day. The recording will be shared. And if there are any other questions that we didn't get to answer, we're going to try and put that into the description on the webinar page. You can find it there. Thank you very much. All the best.